Are you investing in various assets but looking for an additional way to earn income? Today, we will explore a powerful strategy that lets you generate extra income from assets you already hold in your portfolio, the covered call strategy. This technique not only allows you to keep your investment intact but also lets you earn a steady income, even when the market remains stable. In this video, we will dive into how the covered call strategy works, when and why to use it, and how to tailor it for the best results. A covered call is an option strategy, ideal for those who already own certain stocks and want to generate additional income without selling them right away. It works by selling a call option on shares you own. The call option gives the buyer the right to purchase these shares from you at a predetermined price, called the strike price, within a specific period. For this, you receive a premium, your extra income. However, be aware that if the share price rises sharply, you may need to sell your shares at the agreed price and miss out on additional gains. Imagine you own an apple and you don't expect its price to change much soon. You could earn some extra cash by promising someone the right to buy it from you at a set price within a certain time. Here is how it works. You own the apple, in this case, your share or asset. You agree to sell it for a set price. You tell someone, you can buy this apple from me at 5 cents within the next week. You get paid for that promise. The other person pays you a small amount, called the premium, to keep the option open. What could happen next? If the apple's price stays at 5 cents or lower, that person might not want to buy it, so you keep both the apple and the payment. If the apple's price goes up to, say, 15 cents, it becomes profitable for the other person to buy it from you at 5 cents. You will have to sell it cheaper but still keep the initial premium. This is the essence of a covered call. You make extra income from your Apple share but might miss out on selling it at a higher price if the value jumps. This strategy is useful when you don't expect your shares to increase dramatically in value soon. For example, if you think the market will stay stable or grow slowly, selling a call option lets you profit even if share prices don't rise. Advantages and risks. Advantage: you receive a steady income through premiums, making better use of your assets. Risk: if share prices rise significantly, you will have to sell them at the lower strike price, missing out on potential profit. The main risk here is the potential for lost profit, not an actual loss. This means you won't lose money, but if shares rise sharply, you will have to sell them at a previously agreed price and miss out on additional gains. In this situation, you can reinvest your capital in new assets or shares that may offer better growth opportunities. This flexibility lets you manage your portfolio effectively and add new assets if you see other promising investments. Want to maximize your income with professional trading signals and effective investment strategies? Join my Telegram channel. You will find regular trading signals, tailored covered call insights, and guidance on market entry and exit points to keep growing your profits. Link below the video. Now that we understand the basics, let's dive into how to set up and use covered calls practically. Here are the main steps to follow to start earning extra income from your shares. Choose the shares you own. First, make sure you have shares in a company that you want to use the covered call strategy with. Typically, this approach works best with stable companies whose stock prices aren't expected to change drastically. Determine strike price and option term. Next, choose the strike price, the price at which you are willing to sell your shares if the option is exercised. Ideally, the strike price should be slightly above the current market price, but not so high that it discourages the buyer from exercising the option. The option's term, usually between 1 week to a month, is the time frame the buyer has to decide whether to buy the shares. A shorter term lets you repeat the strategy more often for regular premiums, while a longer term increases the chances of the option being exercised. Sell the option and collect the premium. Once you have selected your strike price and term, sell the call option on your shares. For this, you receive a premium upfront, guaranteed income, regardless of what happens next. You can keep this as extra income or reinvest it. Wait for the outcome. Now there are two possible scenarios. First, if the share price stays below the strike price at expiration, the buyer won't exercise the option, and you keep both the premium and the shares. Second, if the share price exceeds the strike price, the buyer will exercise the option and you will sell the shares at the agreed price. In this case, you keep the premium and the sale proceeds. During overheated markets, when you expect stability or a slight decline, you will earn a steady income from options and dividends, even during a prolonged bear market. For companies with slow or moderate growth, this allows you to maximize income by combining dividends, option premiums, and gradual capital gains. When one of your stocks becomes too expensive compared to its fair value, instead of waiting for the stock to be overpriced, you can generate additional income by selling covered calls at a strike price well above the stock's fair value. Covered calls can be an incredibly valuable strategy when used correctly, but they are best suited for stable or slow-growing stocks. This approach allows investors to make the most of their existing assets by generating additional income without giving up ownership. However, like any financial strategy, covered calls work best in specific conditions and require thoughtful planning to maximize benefits and minimize risks. If you want to enhance your portfolio with covered calls, remember that timing and stock selection are key. Use this strategy to complement your investment goals, balancing potential gains with income stability. And if you're ready to explore more ways to optimize your investments, stay connected. Thank you for watching, and if you found this guide useful, please like, subscribe and hit the bell icon so you never miss our latest strategies. For even more insights and advanced trading signals to help you master strategies like covered calls, join my Telegram channel, link in bio. Ready to take your income strategies even further? Watch the next video to keep learning and growing.